Good afternoon and welcome to this Yellowstone Advisory webinar with Rotork plc. We're delighted to have with us today Gig Hoon, Chief Executive Officer, and Andrew Carter, Director of Investor Relations, and Ben Peacock, the Chief Financial Officer. But I would now like to hand over to Gig to start today's presentation.
So good afternoon, everyone. Thanks for dialing in and thank you for showing your interest in Rotork. My name is Gig, CEO of Rotork. I'm joined today by Ben Peacock, our new CFO, and also Andrew Carter, our IR Director. As Alex mentioned, I'm going to take you through some highlights of our results presentation, and then we'll hand the floor over to questions. Move on.
Yeah, sorry. Okay.
So to start, I'd just like to give you an overview of the key drivers that underpin Rotork's growth strategy and why we're confident that we can continue to deliver our mid to high single-digit revenue growth over time. So on the left box, you can see the industrial megatrends. These are the key megatrends that underpin our growth trajectory and objectives across all of our end markets. And they are automation, electrification, and digitalization. We also have those coupled with our Growth Plus strategy, which consists of three key pillars: our target segments, customer value, and innovative products and services, all underpinned by our foundations of enabling a sustainable future. And as we go through the presentation, I'll give you some examples of our key target segments and how these industrial megatrends have taken hold and how we've used these to deliver growth. So you will have already seen our results presentation or our results, but just to give you a few key highlights from my perspective on 2023. I think in 2023, we delivered a really strong set of results, and we're really pleased with progress so far. We had a very strong second half in particular, and then that culminated in a year-end growth of near 14% revenue growth, OCC. Margin improved 60 basis points to 22.9%, and our return on capital remains very strong at 33.9%. We also ended the year with a cash position of 134 million, having had a cash conversion of 120%. So that puts us in a very good position, and you would have seen that we have initiated a 50 million share buyback, as well as retaining enough firepower to execute on our M&A pipeline and strategy. As well as the financials, we're also really pleased with our non-financial progress as well. The first being our health and safety performance. So in the year, we reduced our LTIR rate to 0.08 from 0.13. So really good results and really good progress within the year. We're also very pleased to have received a AAA rating from MSCI ESG. If we move forward, I think something else we're very proud of as well is that we are also delivering sustainability along with delivering returns. And amongst other things, or a number of things, we've managed to reduce our scope 1 and 2 emissions by 11%. And we've also received a number of external recognitions, the AAA rating, as I mentioned in the previous slide. This is an overview of our Growth Plus strategy with the key megatrends underpinning all of our end markets. And just as a reminder, our target segments are key segments where we've identified niche markets that are fast growing, where we have the right to play, where there are good profit pools, and where we will double down to focus to grow in our business. This doesn't mean we're going to ignore the rest of the business. We're still going to maintain and grow that. But the target segments is where we see us focusing on delivering our accelerated growth. The customer value pillar is all about putting the value to our customers at the forefront of everything we do to deliver a seamless customer experience. So that is to go along with our market-leading products and our market-leading site services. If we can also be market-leading within our customer services pillar, we'll have all three elements, which again will help drive our growth. Then the last pillar is about innovative products and services. That's all right. You move that.
Yeah.
Rotork is seen as having the leading products in the market, especially within our electric actuators, and we want to keep this up. So we need to continue to innovate and stay ahead of the competition. So we continue to invest in our innovation to develop new products and services. And all those three pillars are underpinned by our enabling a sustainable future philosophy. Okay. So what I wanted to do was to give you more insight and more depth into our target segments strategy. So we basically said that within our capital markets day that we did around 18 months ago, that our target segments represent around 50% of our business. And last year, those target segments grew at around 15% OCC. We've also said that roughly within our capital markets day that the combination of all our target segments has a market growth rate of high single digits. And this is the reason why we're confident that we can deliver mid to high single digit revenue growth over time as part of our financial ambition. So to give you a couple of examples of the target segments in action, coupled with the underlying megatrends, the first one you can see is what we call upstream electrification. So we launched an initiative around 2 years ago to reduce methane emissions reduction within the oil and gas market in upstream, and that's predominantly in North America. Since then, we've made a lot of traction, and the key driver in the success for us is the replacement of manual and pneumatic valves within well site production processes. And I'll go into a little bit more detail into the next slide. But we believe that there's structural growth trends of electrification happening in this market to help reduce the methane emissions, and that's what we're capitalizing on as a key growth driver going forwards. The second pillar is an example within our CPI, Chemical Process and Industrial division. As part of the CPI strategy, and again, I'll go through in a bit more detail in a couple of slides' time, we're targeting niche markets that are growing fast that we can help supply products into to deliver solutions for those markets. One of the trends that we've identified is the increase in battery production. So we've targeted key segments along the battery value production chain. So industries like specialty chemicals, where they're making the materials for the anodes and the cathodes. Then mining, where they're actually mining the critical materials for the batteries. And then in the HVAC systems in themselves, which is more to do with the fire suppression damping within battery production plants. We're targeting all of these niche elements that are related to the battery production, as we think batteries production is growing. Hence, this is a key driver to help grow our business, and is a key reason why CPI has grown over the last couple of years. Then the last example is within water and power. So this is an example of the largest water and power project that we've received in our history. It's to provide specialist actuators and gearbox combinations to a town in the Middle East to get potable water to these towns. So just to go into a little bit more detail in terms of the upstream electrification, at our Capital Markets Day around 18 months ago, we introduced our methane emissions reduction initiative, where we are targeting upstream wellheads and production processes, as you see on this slide. And we're targeting the replacement of manual valves and pneumatic valves to reduce the emitted methane. That can be in terms of the flaring, or actually in terms of the actual operation of the pneumatic valves in themselves, because those pneumatic valves are using the methane coming out of the ground to operate the equipment. The best way to eliminate the methane in terms of that example is to switch from the pneumatic product to an electric product, which completely eliminates the need for the methane to operate the actuators, the pneumatic actuators. Since the Capital Markets Day, we've done a really good job in establishing our electric actuator product, the IQTF, on new wellhead choke valves. So on any wellhead choke valve that is new, 50%, we get 50% of any of those wellheads that are electric. So we've made really, really good traction. Elsewhere on the production process side, that's the area where you can see within the red dotted lines, we're making steadier progress within those elements, as the pneumatic actuators operated by methane at the minute, an alternative way to operate them is to use compressed air. And that's why we're making steadier traction in that area, but very significant fast progress within the wellheads, which are the two drawings that you can see on the left. So the market size that we highlighted in our Capital Markets Day for this market was around 200 to 300 million at its maturity. However, what we don't know is the ramp up and the curve up to that maturity. However, we have made some really good progress. We believe that ramp up could be accelerated through what has come out of COP28 and through the EPA rules. So whilst COP28 is relatively new, we believe that this could be an exciting progress within the rules to help accelerate the transition of pneumatic and manual valves to electric valves. So a great opportunity for Rotork, and actually a very much structural trend for growth. I then wanted to take you through an overview of CPI. We've had feedback from a number of investors that they wanted to understand a little bit more of what is behind our CPI sector. And so we disclosed a little bit more around what makes up CPI. But essentially, CPI are supply specialist actuators and instruments for niche critical process automation sectors. There are two key drivers of how we grow CPI. The first is we identify structurally growing markets. So we identify niche markets that are growing. The growth trends are structural. So the example I gave is the battery production value chain. We then look to do business development within those markets. We look to work with the end users to become specified, and then we look to win business based on that. The other way we do it is that we look at where we have niche markets but small market share, and again, we look to accelerate our market share in these areas. We've actually been doing this since 2020, and you can see that since in the last 3 years that the CPI growth has been 11.4% compound annual growth rate. So we're really pleased with how the strategy is coming through. This is a key principle of our target segment strategy within the Growth Plus strategy. So we can see that it's working, and we've delivered good growth in the last 3 years, and we continue to expect good growth to carry on. The pie chart that you see on the right is a little bit more detail about what's behind the CP and I. In the past, the I part, the industrial part within CPI, has been a little bit misrepresented. So people have been taking CPI and applying industrial automation data, PMI data to the whole division to look at indicators of whether that division is going to grow or not. But actually, that can't be done because really the I part is a very, very small part of CPI. The biggest part is the process part, and that's the part that we've grown, as well as the chemical part you can see in the red. So those key segments make up CPI. And you can see that the battery value chain element spans from the specialty chemicals through to the metals and mining sector, through to the critical HVAC segments as well. So then moving on to our outlook, we remain positive about the outlook for all three end markets. Within oil and gas, we see a catch-up of the underinvestment into the industry over the past 5 years, and customers are focusing their spend on energy security, energy transition, and emissions reduction. And those investments have seen Rotork's key target segments grow, and we continue to expect those to grow in the short, medium, and long term. LNG also plays a key part of our medium to long term growth strategy, and LNG remains strong as well. Within CPI, we've just covered that. We're focusing on fast growing end markets, ones with structural drivers. We've been doing this for the last 3 years, and it's yielded extremely good results, and we'll continue to do this, focusing on key target segments to grow the business. In terms of water and power, water has always been a very good growth driver for Rotork. The continued investment into water infrastructure, so whether it be in replacing aging water infrastructure or in putting new water infrastructure in countries like India or China, we've seen these trends grow, and we've seen our sales grow on the back of that. Water scarcity has also been a key driver within the water sector. So water recycling, reuse, and also desalination has also been key target segments for us, and segments that we have seen grow. Power, on the other hand, over the last few years has been reducing for us. However, last year, power grew in line with water for the first year. So we're actually seeing a positive uptick in power linked to the energy security drivers. You know, people are seeing that hydrocarbons are still needed, and that's driven us an uptick in the traditional power markets. So then, just ending on our summary and our outlook, we delivered a strong set of results in 2023. We're very pleased with our performance so far. We believe that our Growth Plus strategy is working, and we are seeing the benefits of the strategy. We enter 2024 with a positive outlook. We've got a healthy order book going into this year. We said at the results presentation that momentum that we've seen at the start of the year has been good, and so we're expecting a year of progress on an OCC basis. I think that concludes kind of a summary of our results. I think the best thing to do now is hand the floor over to questions.
Brilliant, Gig. Thank you very much for that overview of the performance last year, and encouraging to hear that you've started 2024 well with a good order book and encouraging momentum. We're now going to take questions, and just as a reminder, if you've got a question to ask, please take this opportunity to put it to the management of Rotork. Type it into the Q&A box at the bottom of your screen, and we'll try and cover as many questions as we can. The first question here, Gig, is on margins. Operating margins are excellent, but are they as high as we can expect? Are we at the point now of peak margins, or is there scope for further improvement?
Yeah, thanks. That's a good question. So yeah, our financial ambitions, as you can see on the screen, actually, is mid to high single-digit revenue growth and mid-20s adjusted operating profit. So with us around 23% return on sales, we're not at peak, and we actually expect continued margin progression over the next few years. What we want to do, though, is we want to balance margin progression with growth as well. So what we're trying to do with the Growth Plus strategy is to build a long-term sustainable growth model. So we'll balance our investments to deliver the long-term growth, as well as delivering the margin progressions up to the mid-20s.
Thank you. Second question here is looking at your cash pile. Do you really need to have net cash of 134 million? Have you considered raising the dividend payout ratio alongside a larger sum allocated to buybacks?
Yeah, we have actually. So we regularly review our capital allocation policy. Within that review, we look at a whole number of different alternatives, of which the ones that you mentioned have been looked at. However, we landed on the share buyback of 50 million because what we wanted to do was also retain the financial firepower to execute on our M&A pipeline. As part of our capital allocation policy, though, it's invest into organic growth, which is what we're doing, and then it's about progressive dividends. So what we want to be able to do is show progressive dividends. Then it's the M&A, and then it's the share buyback. So what we're actually doing is we are actually executing or carrying out our capital allocation policy.
Okay, thank you. Question here about your competition. Who are the main competitors in the main segments?
So the kind of main traditional competitors are, they differ for different end markets. So the main competitor for pure electric actuator is Alma, is our biggest one. They're a private German company. However, they're very, very big in water, but they're not very big in oil and gas or in CPI. And then the other competitors behind Alma would be Emerson, with their Biffy and their Bettis brand. And we see them across all three end markets. Flowserve, again, with Rotork as their brand. We see all of them in their end markets. So they're the top three, I would say. And then behind them are companies like Bernard, who are, let's say, smaller players.
Okay. You obviously got an optimistic start to 2024, but what are the main challenges for the coming year, and how do you intend to tackle them?
Yeah, I mean, there are a number of challenges, but actually I view 2024 on the whole as positive. So obviously there are wider macroeconomic uncertainties. You know, a number of countries are going through election years, which could have bearing on direction. So whilst we're mindful of the macro trends, you know, we're confident in our growth strategy. We're confident in Growth Plus. So our focus is on really executing and delivering the initiatives that we set ourselves to deliver the growth. And if we do that well, I anticipate that we will continue to grow. So that's what we're doing. We're focusing on delivering our initiatives in the year, whilst being mindful of the wider economics and being quick to move depending on what comes up.
Okay, thank you. Moving across into a slightly different area, do you use additive manufacturing?
We do use additive manufacturing, but more in the prototyping stage rather than the final production stage. What the industries we play in are mission critical. A lot rides on if something goes wrong. And so actually our end customers are more nervous about having that technology. But what we use it for is rapid prototyping, getting prototypes made, tested for functionality, things like that.
Okay, thank you. Back onto the competitive front. Do you expect to see competitors or more competitors enter the oil and gas electric valve sector?
No is the answer, actually, because it's quite it's a market that has very high barriers to entry. And so an example is Alma, for example. Alma have been around for a number of years, just like Rotork. But Rotork has grown up, let's say, in oil and gas. Alma has grown up in water. We've seen Alma find it extremely difficult over the last 20 years even to get into the oil and gas market. And the reason for that is because that market, again, is mission critical. It needs explosion-proof products. And it's a in our type of products, it's relatively low compared to the total cost of the setup. And so whilst the value is relatively low, but we make good margins out of that value, but the criticality of if something goes wrong is high. Actually, a lot of the designers and a lot of the end users won't change unless something goes seriously wrong. We are seen as the leading brand for reliability. You basically buy a Rotork product if you want to fit it and forget about it because nothing will go wrong. That's why you buy a Rotork product. And so actually, because of that, because of those, we find that new entrants into the market find it very tough to get traction at all. And actually the competition that I've described has been the competition for the last 10, 15 years, with no new real entrants coming in. And even with a big player like Halma, they've really struggled to take market share. So I don't anticipate kind of new entrants coming in and really taking market share rapidly. Doesn't mean we shouldn't be mindful of that, though.
Very, very conservative industry, I think, that we serve. I think that's the main point. Even when Rotork launches a new product, it tends to take quite a long time for customers to test it and accept it, etc. So for somebody else to come in is even more difficult.
Okay, thank you. Some supply chain issues sort of mentioned across the industry through 2022, and a question here saying, have the sort of supply chain problems with, for example, semiconductors been fully resolved now, and how do you see that playing out this year?
But by and large, they've been fully resolved. So in 2022, there was serious issues across every industry. We at Rotork have put in a number of mitigations to help us through that. From chips were going obsolete, so we redesigned to have more readily available chips. We found alternative suppliers. We bought in-house specialist sourcing teams on chipsets themselves. All of those things have really helped us, and we retained those items. Last year we saw it get better. What we saw last year was long lead times on PCB manufacturers. So because then the chips were made available, there was an onslaught of orders onto the PCB manufacturers, which meant lead times went out on those. They're now coming back in. So by and large, everything is resolved.
Okay, thank you. What percentage of your embedded kit is not digital, and does this give you a replacement opportunity to bring in new digital product?
That's a really hard one to answer, actually. We don't have a metric in terms of how much is not digital. But if I can say this, electric actuators are digital, and I think electric actuators make over half our sales. Instrumentation is digital, and again, they make up about 20%. So maybe at least, let's say at least 2/3 of our products are what you could call digital. The gearboxes that we make are not digital, but they couple with the actuators. So essentially they go hand in hand, and then it's really the pneumatics and the hydraulics that are not digital. So you could say, let's say at least 2/3 of our product ranges are digital. And one of the mega trends is the digitalization, and we're really trying to leverage that. We launched last year what we call our Intelligent Asset Management Program, and we're really trying to leverage that to give our customers more data around their control systems. Our products actually was able to record data from about the 1990s. So all of our electric actuators could record everything that was going on, even back to the 1990s. It was the adoption of our customers that was slow, but we're seeing more and more adoption of that from our customers. So we see that trend is a positive growth going forwards. Okay,
thank you. I think you mentioned, strong cash generation and how you are allocating that across different areas. Question is there still scope to further consolidate the market?
Can you, I'm not sure what you mean by further consolidating the market on that one.
I think the question is really pointing to other opportunities for you to make more acquisitions and to, do some bolt-on acquisitions, or maybe even go into some new markets with some bigger acquisitions.
Yeah, absolutely. So if I talk about our M&A pipeline, have opportunities in there which I would call by and large bolt-on opportunities. So we're looking at predominantly bolt-on opportunities, and those opportunities would do one of two things. A, they would either complement our current product portfolio, which means that we can accelerate growth in existing markets, or like Hanbay was, it can help us move into other adjacent markets as well. So that's kind of a key driver of our M&A pipeline, either adjacencies into new markets and adjacent products that will help us into new markets, or expand into our existing markets. That's the kind of opportunities that exist in our pipeline.
Thank you. Very clear. Rotork here has a reputation for excellent products, but long lead times. Is this a deliberate strategy to give order backlog visibility and production load balancing?
No, it's the short answer. It might be an unintended upside of having longer lead times, but that's not a key driver. Actually, I mentioned about the customer value pillar, and I mentioned about providing a seamless customer experience. So one of the key drivers within that pillar is to reduce lead times. So what we want to do is to provide market-leading lead times. Now, Rotork's lead times are actually in line with our competition lead times. Sometimes we're better, sometimes we're behind, depending on the product ranges. So by virtue, our lead times are long, but they're not longer than the competition. They're in line. And what we want to do actually is to shorten it so that we are better than the competition across the board in terms of our product portfolio. We believe that will give us an advantage over our competition. That being said, within a kind of makeup of a production plant or a facility, typically the Rotork product is the shortest lead time product. So if you're looking at our chemical plant, an oil and gas plant, or a water facility, the actuator is always the shortest lead time within that. So they don't need to be super short because it wouldn't help, but being shorter would help give us competitive advantage. So actually, we want to reduce our lead times.
Okay, thank you. Are there any products or segments that you currently operate in which are now quite small, but could really grow, quite excitedly over the next 5 years?
Yeah, absolutely. There's a number of them, but this is part of the whole target segment strategy. So CPI is growing at 11.4% compound annual growth rate. 3 years ago, the battery production segments were quite small, and they've really grown. HVAC into semiconductor and data center markets were quite small. They've really accelerated and grown. So that's the whole ethos of what we want to do. So currently, what I would say is the carbon capture hydrogen segments are relatively small. The pipelines are actually quite big, but the opportunities that we win is still relatively small. But we can see those accelerating going forward. But the thing is with those is you have to be there at the beginning. You can't decide to come in at the end or in the middle. And that's why we're really focusing on hydrogen and carbon capture, because what we're doing at the moment is getting specified in with the end users. That's the whole real selling piece. If we're specified in and the market takes off, it's really hard for someone to come in and get specified in whilst the market takes off. So you get quite a lot of advantage by being first movers. And we've seen that in the upstream electrification case, where 2 years ago, we were first on the market, we were there, now we have 50% share of the choke valves as that market is expanding. We want to do the same with the carbon capture piece and the hydrogen piece. So they're relatively small that could accelerate. The other one is the HVDC, the offshore wind market. That could be a very exciting market for us. Again, we're doing a lot of work getting specified in with the end users. We've won a couple of contracts, but that's another area which could be significant for us going forwards.
And maybe desal possibly.
Desal as well.
Yeah.
Desalination, that's slightly bigger actually than the others I mentioned, but desal was another one which was relatively small but has actually grown quite fast over the last few years.
Okay, we've got a couple more questions about individual sectors. What's your exposure to LNG production and transportation?
We haven't disclosed fully the number of our disclosure, but within our, even on one of the slides that I showed, within our market outlook slide in our results presentation, we've given the breakdown of oil and gas. So oil and gas was 46% of sales within Rotork last year. We haven't given the number, we've given a segment of the gas piece that is LNG. That will give you relative size. However, bear in mind that that segment size will grow because it's one of our target segments. However, the growth we're not at that point where we're going to see orders yet. So we're at the point where we're doing a lot of work with EPCs and end users to become specified. We're expecting to start getting orders end of this year, start of next year, but really the real peak of the LNG growth, we're expecting to come through 26, 27, 28. And so we expect that piece to get bigger as more and more LNG projects come through.
Okay, thank you. And then looking at the CPI sector, CPI revenue growth lagged the other divisions in FY23 with flat operating profit. Will this continue to be the case in 2024 as well? And will margins remain at the 23 level, or is there scope for those margins to rise?
I would say that there's scope for those margins to rise. So actually CPI over 3 years has been the highest growing CAGR. Last year it was the lowest growing at 9.7, so still pretty good growth, but it's been the lowest growth rate of CPI, which shows you the power if we're saying it's the lowest growth at 9.7%. Last year was let's say a year where we had some one-off projects which were relatively low margin, which we don't expect to repeat. So I actually expect CPI margins to improve going forwards.
Okay, thank you. And a question here on the service division. I wondered if you could give a little bit more detail around what's involved in the service division, and is there a scope to expand that?
Yeah, so service is a key growth driver for Rotork. However, it's not a separate division. So we break out the service number because people like to know what the service number is, but actually service sits in all 3 of the end markets and it's not a separate division. So one of the growth drivers within the end markets is to sell more service, more aftermarket. And that is a key lever for growth. So I think last year service was around, or aftermarket was around 21%. We expect that to grow at least in line with growth, or if not slightly ahead. So we haven't set a size in terms of it will get to X big because it's a key lever for growing. You see, but as you grow one division and you grow service at the same time, you'd expect the percentages of growth to stay the same. But it is a key lever.
And just a question for me here. Where do our aftermarket margins sit compared to the rest of the business?
Ooh.
Again, we haven't disclosed that, but you could expect it to be good.
Okay, good. We'll note that. We've got a couple more questions left. Just to remind people, if they do want to ask a question, now's the time to put it into the chat box, because I think we've probably got time to cover a few more. How much exposure do you have to China?
Yeah, China, I think we've disclosed
by sales by origin are
Yes.
actually in our results.
Yes.
Um,
So whilst Andrew looks at that, so we do have exposure to China. However, we still expect China to be a good region for us. So whilst it's slow, it's still growing at 3 to 4%. I think the official GDP figure of China last year was 5%. And so whilst China is slow, it's still faster than Europe. And so it remains a key region for us. And actually, we expect oil and gas to be strong in China going forwards over the medium to long. CPI has actually grown in China quite significantly. It has been a bit slower for us in the process markets for CPI last year, but the battery value chain segment within China has been really good for us. So whilst it has been slower, we still think it is a good region for us.
Yeah, just to give some numbers. So this is in our press release in terms of sales by location of subsidiary. So China in 2023 was just over 100 million of the nearly 720 of revenue. So it's around sort of 14%, something like that. If you did look at that though, just as Gig was saying, you will see that sales by origin China did decline 22 to 23. But what we also said in the press releases elsewhere was that overall our sales to China didn't decline by that much. So what you did have is this slightly difficult situation to explain to a simple question, is that in China we did see sales come down, but overall the group level didn't come down by quite as much because we were exporting more product from other parts of the group into China overall. And I think it's worth saying, as a follow-on to one of the earlier questions about the CPI margin, the China market for us, the local market, is a profitable business for us, electric actuators, instrumentation, and the like. And so part of the reason why the CPI margin was held back a little bit was partly to do with the China business being down, which is a reasonable part of CPI.
Great, thank you. Next question, is the manufacturing all done in-house?
So our manufacturing model is to purchase components and then assemble and test in-house. So we're a asset light principle that we don't have much vertical integration. We buy all of our components. So we design our products, we have IP on our products. We then partner with suppliers to bring in the components, we assemble, we test, and then we ship.
Okay. Can you expand on the typical market adjacencies that you would see as synergistic?
Yeah, so there's two, if I answer it in two ways, there's product adjacencies and market adjacencies, okay? If I look at the product adjacencies, within our markets, we have instrumentation and actuation. And actuation includes gearboxes, but part of our M&A pipeline are edge devices like sensors, temperature sensors, pressure sensing. So products that complement the flow control principle. So that's one adjacency where we can generate different revenue streams through our M&A pipeline, through different product ranges within the same application. So that's one area. The other adjacencies are a bit like our target segments, where if I take critical HVAC as an example, we had a large business in supplying fire damping suppression systems in tunnels. And we took that technology and we applied that technology to data centers and to semicon plants. We hadn't ever done that. 3 years ago, CPI division said, where else could we take this technology and go into a new market and actually find applications that are very similar and could have similar solutions, but in a completely new market. So from that, we were able to develop critical fire damping suppression systems in data centers, in semicon plants, in battery production plants. So hopefully that's an example of how we take our same products and go to a different market and we grow the business. So hopefully that answers the products within our same markets and then taking the same products into new markets.
Yeah, no, that was great. I've got two more questions to ask here. I think got time to cover them both. The first one is a bit more of a technical question. Is there any currency hedging in place, and how much do fluctuations in the dollar sterling exchange rate affect earnings?
I'm going to have to hand that over to my financial friend.
Do you want this?
Well, in terms of there is currency hedging in place. It's on a transaction basis. In terms of the actual headwind or tailwind on the FX rates, can you just cover that?
Yeah, so at the time of the results, obviously the currencies are moving around a little bit, not too much. My colleague Jonathan said that headwind to revenues this year was probably going to be slightly less than 3%, and the headwind to profit might be a little bit more than that, so slightly more than 3%. The reason why they're a little bit different is not really to do with us necessarily having big manufacturing plants that have transaction exposure. It's slightly more about us having our PLC here in the UK, but actually in particular on top of that, our biggest R&D centre for electric actuators is here in the UK as well. So we do have slightly higher UK costs.
Okay, thank you. And then the last question we've got here is on EVs. EV growth seems to be hitting some bumps in the road. How might this affect Rotork?
Yeah, I think the EV growth will then affect the battery production growth, let's say, as that. But I think the way I look at it is over the long term. You know, there will be bumps in the road, but it's like share prices; they go up and down as long as the overall trend is up. And so I think whilst they could affect the short-term battery production segment, I don't expect it to be a medium or long-term issue at all.
Mm.
And that's we don't have much in electric EV other than the battery production. But again, the battery production that we're involved with isn't just batteries for EV; it's for a number of other segments as well.
Mm. I think possibly the follow-on to that is really just to say that I think we would agree that the acceleration that you've seen in sales of electric vehicles is probably, for a period, it was going a little bit faster than people thought, and then more recently, with interest rates going higher, it's come down. And I think it's caused the energy industries, the traditional energy industries, to rethink some of their investment plans and what they're going to be needing to do. And I think it's one of the contributing factors, along things like energy security and a few things like that, as to why you're seeing a pickup in activity in the oil and gas sector more globally. So from that perspective, it's good news for us. Obviously, what Rotork wants to be doing is to be very much involved in the cleaner end of energy and being involved in things like the carbon capture and the hydrogen and the methane emissions reduction and all those kind of things as well. So I think it's overall, it's probably, I'd say, a positive for us.
Brilliant. Thank you, Ben. Thank you, Gig. Thank you, Andrew. That brings us to the end of today's webinar with Rotork. We really appreciate you talking to private investors, and thank you for all the private investors who have come on to listen to the presentation today. And we wish you all the best for 2024. So thank you, and we hope to see you soon.
Thank you very much.
Thanks all.
Thanks a lot.